Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. The most read story on the Bloomberg Terminal here is about this Bank of Japan and raising rates, scrapping the world's last negative interest rate, ending the most aggressive monetary stimulus program in modern history, but also indicating that financial conditions may stay accommodative for now. This is big. It's the most read. I'm trying to get a sense of how important it is. Maybe our next guest can help out here. Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets. Jennifer, thanks so much for joining us. Can you put into context what the Bank of Japan did today and what it means? Because, again, most read story on the Bloomberg Terminal.
For sure. Good morning, everyone. Thank you for having me on. I think this, first of all, I have to thank all the local Japanese media for leaking out all the moves ahead of time. So, as you can see from the reaction of the markets, it wasn't a huge change in terms of reaction, I guess. But what this basically means is that, as you just pointed out, the last era of negative rates, and now we're turning to something more normal. Try to explain to anyone out there, what the heck does negative rates mean? Japan's have had this for so many years now. So now they're finally back to normal, peaking above, we're back in positive territory, although at 0 to 0.1% range, it's still extremely accommodative. But again, it shows that the Bank of Japan is no longer asleep at the wheel and is finally moving toward a more normal condition.
And Jennifer, I'm looking at some of the market reaction from analysts and strategists, basically saying that the forward guidance doesn't close the door on another hike. Is that something that you agree with? What's your read on what could be next?
So I did see, some people penciling, a series of rate hikes. I think it's, way too soon. I mean, this bank is very deliberate and very, careful of what their moves are. Obviously, we've had inflation well above the 2% target for, over 2 years now, and now they're finally moving. But, I think it's way too early to say that this is the beginning of a series of rate hikes. I wouldn't be shocked if we see one more move, but as you just pointed out, like the statements still said that they're going to be very accommodative for some time. They're still buying JGBs. They're going to buy more if you see some sort of a big abrupt move in the JGB market, which we're not seeing this morning. So it all depends, but they're still out there. They're still keeping rates very, very low. Again, not negative, but at least it's, that's still very close to zero. So still very accommodative. I think it's too soon to say that there will be a series of rate hikes, but I wouldn't be surprised if they kind of nudged it up a little bit further, depending on obviously how things play out. Everything is data dependent and not calendar dependent, to use all the famous words that various central bankers use these days.
Yep, busy week here for central bankers, to be sure, not just at the Bank of Japan, but tomorrow with the United States Federal Reserve. What do you think we're going to hear from Fed Chairman Jay Powell? I mean, obviously most people don't expect any movement in rates tomorrow, but what kind of commentary do you think we'll hear?
He is going to stay uber cautious, I think, especially after what we saw the last week with the sticky inflation numbers, both for CPI and PPI, and the still, in my opinion, a little bit questionable retail sales data shows that, we're again, we have still to be very cautious with what we say. I just have to say briefly about retail sales. I was kind of disappointed to see that I'm going to say crappy, January retail sales results, even lowered, even crappier, even though we did see the bounce back in February. So it's sort of interesting to see how that's going to play out. But definitely sticky inflation is what they're going to be worried about. And the Fed chair is going to be extremely, extremely cautious in what he says. He doesn't want to, cause any undue, hoopla, I guess, in markets to say, to cause everyone to speculate that they're going to be cutting earlier or whatever. But I think he's probably going to push back again on expectations of when the Fed will finally cut rates. We're sticking to our July call. I think it'd be very interesting to see what the dot plot does, whether or not they're going to stick with those 3 cuts I think that they have penciled in for this year.
Yeah, Jennifer, looking at the WIRP function, WIRP on the terminal, the first full cut fully priced in July, to your point, with potentially three, yes, at least according to our data, through the end of the year, early 2025. What can Jay Powell say from a hawkish perspective that could make investors reshape expectations?
He could talk about being very worried, or he won't say very, but he'll say that, we're still concerned about how inflation is still sticky, services inflation, the super core measure and all that. Again, just sounding a little bit more concerned, I think would cause markets to push back the timing, I think, a little bit more. But again, he's been saying this, for some time now, and I think he's just going to stick to that script. And any sort of swaying away from his usual wording will cause markets to pounce as well. So he has to be so careful of what he says, how many times he says, how many times he blinks, everyone will be focusing on every little nuance that he does, anything that's different from what he has been, doing in the past few months.
Jennifer, what's your thoughts about the overall, just looking at the U.S. economy here? It looks like inflation is trending in the right direction. There's still moderate economic growth. It looks like the employment picture is pretty steady. What's your overall view of the U.S. economy here?
Still, and I'm going to use the word that your a couple of guests ago was kept saying as well. It's still quite resilient. I don't think anyone can or should be arguing that. I mean, after 525 basis points of rate hikes, the economy is still growing at a solid pace, and that's extremely impressive. And people are still hiring. There may be some evidence of hoarding, as we talked about in the past, but at the same time, we're not seeing mass layoffs either, which is very good news. And it just speaks to, again, the resilience of the U.S. economy, the resilience of the labor market. The consumer still has, a little bit of cash stashed away for a rainy day. And even though, the consumers are also, quite volatile in terms of their confidence levels, they still have stuff in the bank to spend if needed. And it's okay to take a breather once in a while. You don't have to spend everything that you earn. But again, it speaks to overall broader resilience. And I think it's still about the U.S. economy overall for this year.
And Jennifer, we have BOJ, Fed, and BOE, but there's this company called NVIDIA having their GTC conference. I talk to investors. They're more focused on NVIDIA than anything related to central banks. Is that concerning?
Well, it's definitely more interesting. I personally wish I owned it, but I think, but of course, everything is going to, we're all going to be hinging on not only the earnings and all that, but of course, what monetary policy is going to be, how it's going to be playing out over the next year, how much easier it's going to be, or less easy, or less tight it's going to be. I think it's all going to go back to what the Fed chair is going to say or not say, and how they're going to act for the rest of the year.
How about this labor market, Jennifer? In the U.S., we did see unemployment tick up to, 3.9%, 3.7%. But still, it feels like this is a fully employed economy here. How do you think about the labor market? How do you think the Federal Reserve thinks about the labor market?
It's still, tight. I mean, yes, we have seen the unemployment rate tick up. We have seen job creation slow, but, 190,000, 200,000 or whatever, it's still, during normal times, this is still a very decent figure. And again, you're not seeing mass layoffs. And this is like a situation that's playing out around the world, even like in the euro area where we saw labor costs tick down. But meantime, you've got the jobless rate still at a record low of 6.4% in the euro area. So this is, again, a bigger picture thing. When you've got, demographics playing out, you've got all the people who are, in the 65 age bracket, all getting ready to retire, the silver wave, I think they were calling it, and we're still seeing shortages in certain areas, certain industries. And because labor markets, again, globally are still quite tight, this is what's going to, I think, it's good news for the economy. I think it's good news for consumers, it's good news for workers, but at the same time, it's bad news for businesses who are still trying, some of them are still trying to find qualified workers. And because of that tightness of the labor market, that's what's going to cause the Fed, or that's also contributed to some of the Fed's concerns, right, I think, over inflation and the economy in general.
All right, Jennifer, thank you so much for joining us. Always appreciate getting some of your time and your thoughts. Jennifer Lee, she's a senior economist and managing director over at BMO Capital Markets. What kind of body language do we get from the Fed here about interest rates? Alex Chaloff, I'm sure he'll be paying attention. He's the CIO of Bernstein Private Wealth Management. Alex, thanks so much for joining us here. I don't know, what are you going to be looking for tomorrow from Fed Chairman Jay Powell?
I think you said it, body language. It's highly likely that the dot plots change, that the language changes, that we go from this beginning of the year idea that we might have as many as 5, 6, 7 cuts down to probably 2 to 4, and wouldn't be surprised to see some emphasis on 2. So our view is that there's no action taken, but that the language changes and to be much more cautious and signaling to the market that we've got some time to wait.
And if we do see a push towards potentially 2 on the dot, how do you think markets are going to react to that?
I think it's been like a slow leak the last couple of months. I mean, part of what's happened this year in equity markets, we've moved nicely, but there has been some reluctance to move a lot higher because I think this is the worst kept secret on the planet, that they're not going to cut as aggressively as many thought they would. So I think the market will be disappointed, but it won't be a disaster.
So what are you telling clients these days, Alex? Just kind of stepping back, the Bernstein Private Wealth folks here. 60-40 portfolio still something you guys talk about? And where do alternatives fit into that? I mean, again, if we're cutting rates, what's kind of the overall positioning here for you guys?
Well, we haven't been 60-40 people for probably 6 years at this point, so we're throwing darts at 60-40. A big chunk of that has moved into alternative investments, both on the income alternative side as well as the growth alternative side. So investors looking at private equity, real estate, private credit, alternative credit of all types. That's really been the norm for our clients. And what we're talking about is a more accommodative environment to really invest across the board once we get past this peak in rates. We're not there yet, so it's a little bit of the waiting game, but we're getting close.
And when you look at the expectations for the full year, you mentioned that 2 to 4 range. What data points could draw that to go closer to 2, if not 1, if apparently Vince Cignarella is calling for none?
Right. I think there's 2 that we focus on most closely. One is CPI, that's obvious, but we've had some volatility in the month-to-month CPI readings. While the longer-term trend is still intact, that we're dropping, that inflation is coming down, you could get those spikes in monthly CPI, so that would be 1. And then 2 is labor. You know, the jobs market has been so impressive throughout this cycle that if we got a real disruption there, that would be nerve-wracking, because there's some of us believe that just as the Fed has tightened and we're starting to see it play out in the labor market, some companies are getting out in front of this to really start to change their hiring intentions and even reduce headcount. And so even though the Fed is working so hard to avoid causing a recession, if we stay at these rates for much longer, we may end there.
So, Alex, my colleague here, Bailey, he's a young Turk. He can go out and take all kinds of equity risk. I'm thinking about the 2-year Treasury, 4.69%. What's wrong with that trade?
There's nothing wrong with a 2-year Treasury as long as you don't have anything to do in 2 years. Our view is that it's better to build now, I don't know, maybe you don't have anything to do in 2 years, but our view is it's better to build a portfolio that has a variable maturity structure to it. We favor municipals for taxable investors over treasuries, a little bit of a tactical allocation to some shorter treasuries just because short munis are so rich. But I would be in a muni portfolio much faster than I would start to build a treasury portfolio today.
You're preaching to the choir, Alex.
I was going to say, I'm bored with munis, but apparently that's where I should be putting money to work. But talking about, Alex, interesting, riskier opportunities, how are you thinking about ex-US investing?
That's where we start to get excited, only because that's the next, right? US large cap, US mega cap, Mag 7, et cetera. That's now. What's next is really our challenge that Bernstein investors look to us for advice on. And our view is next could be Europe. Next could be some part of emerging markets. I think when you look at Europe, you have to acknowledge that EPS growth there will not keep up with the US, so it's more of a valuation play. And EM, you have to be okay with taking some macro risk of China. I think that the numbers out of China have started to slowly improve, but that's a long path out. So number one, you've got to be a long-term investor. And number two, you've got to size it correctly, because even though we think it will work, it's going to have some volatility around it.
So Alex, at Bernstein Private Wealth, To what extent do your clients come to you and say, I really want exposure to alternatives, whether it's hedge funds or private equity or private credit? And if so, what do you think is a reasonable allocation to alternative investments?
Yeah, our investors have expressed both a desire to invest in alternative investments, but even in larger numbers, they want to move away from public markets. I think the experience of the last few years, 2020, COVID was really scary in public, even though we ended up in a good place. 21 was terrific, but it never felt terrific. 22 was really hard. 23 was another year where at the end of the year, you couldn't believe how much money you've made that year because it just didn't feel that way. So they're looking to get away from public market volatility, both equity and fixed income volatility, by the way. So I think some of it is absolute attraction to alternatives, but a bigger chunk is this idea of how do I get out of the publics? And so we have been investing heavily in private equity, both primaries and secondaries, really excited about fresh capital right now, getting put to work in real estate. One of the things I would say across the board in longer dated alternative investments is that you don't have this big flood of other big institutional LPs applying capital. There's been some reluctance because of the 2022 public market experience and how these big LPs are trying to right size their liquid versus illiquid. So they're taking a year off, maybe two. They've definitely hit the timeout button. And so we're able to step in. Other groups like us are able to step in and acquire assets at a much lower price because it isn't as heavily trafficked.
Alex, to quickly touch on that, I cover equity capital markets and IPOs. You're talking about the private markets and some of the issues for LPs and GPs. Where do you see opportunities within the private market, given the disconnect that you're talking about?
I would first point to real estate. I think there's a number of real estate funds, big multi-billion-dollar funds that were raised 10, 12 years ago that still own assets they need to sell, whether they restructure in a continuation fund or they're looking to do off-market secondary-like transactions. I think you're going to see some significant deal flow there.
Yep.
You know, last year, 2023 was the lowest deal volume in commercial real estate in like 25 years. So we have to see the other side there.
Trying to call
and then I think in private equity and venture capital, you're just not seeing the valuations that you had to pay 3 or 4 years ago in those private markets. You're already seeing the lack of big capital investors there bringing valuations down.
Alex, great stuff as always. Appreciate getting a few minutes of your time. Alex Chaloff, he's the CIO of Bernstein Private Wealth Management. So when I think about flailing around in the dark, I think of Vince Cignarella, macro strategist for Bloomberg News, the master of working from home. Vince, what are the traders telling you out there? You talk to these guys and gals all the time. What are they telling you?
Well, I think now that we're, realistically, we're pushing the rate cuts back now out to July. So every month or so, we seem to be pushing them further and further back. And, we're bumping up against the presidential election at the same time. You can't rule out that influence on Powell. Remember his interview with 60 Minutes. The big mic drop moment for him was to make sure that people understood that the independence of the Federal Reserve was paramount. And he's not going to want to play into politicians' hands, basically trying to make him a scapegoat as if he were picking, a horse in the race, because he doesn't and won't. So if we get to July and that's the first rate cut, and Bostic has mentioned that they're not going to be back to back, and I think he speaks for the committee. You're not going to see one in August, possibly even September. I don't see how you get 3 in. And even more importantly, in all my years of watching the Fed, and it goes back to the late 70s, I can never remember a Fed cutting interest rates when the economy was growing, when inflation was either stagnant or ticking potentially higher, and jobs growth was strong. I realize there's a gap between where the Fed funds rate is and where the inflation rate is, but that doesn't necessarily mean the Fed has to close that in a heartbeat because of the fear that potentially could turn. There's no reason to believe that that gap is going to remain at roughly the 2% spread that it is right now. And I think the traders are over their skis on this.
Hey, Vince, but for the longest time, you were saying that the Fed should be cutting rates, that they were behind, that they should be cutting rates. What's changed?
Well, I think what happened is they missed the boat. They took too long. As inflation was coming down from that 5.5 level to the 3.5 level, they had every opportunity to cut rates. They had 2 years to cut rates. so afraid that they were going to be behind the curve again, as they were in the transient story when they forgot to raise rates, that fear kept them back from cutting. Now we're in a situation where inflation has stopped going down. So now they have the worry that, wow, if they cut rates now, could they fuel inflation? Could they cause inflation to tick higher? You know, as inflation was coming down, inflation is just as much a psychological influence on consumers as it is a factual influence. As inflation was coming down, had they started to cut rates back then, maybe 18 months or so ago, that would have fed into consumer expectations that things were getting better, prices might be coming down, and you might have seen prices come down a little bit as consumers change buying habits. But with the Fed holding rates where they were and keeping mortgage rates as high as they are, that's changed consumer behavior and changed consumer sentiment. And now I think is a point where it's too late. Now they need to see inflation begin to start slowing once again before they can pull the trigger. And that's not what we're seeing right now.
Vince, you're a former trader. How would you be positioning right now?
Me, if I were playing the yield curve, I think there's absolutely no reason to be anywhere but 2 years. And you're looking at roughly 4.7% on a 2-year yield. You're looking at 4.30% on a 10-year. There's no reason to pay for duration. Two things are going to happen. I'm dead wrong and the Fed cuts rates sooner, which means the 2-year out rallies way better than the 10-year because the curve will steepen, but it'll bull steepen in favor of twos. I'm right, and the Fed doesn't cut, and if they don't cut, twos will probably stay reasonably within where they are, but you'll see steepening of the curve as the back end reprices for higher inflation down the road. So there's no reason to be paying for duration right now. I would stick in the short end as far as treasuries are concerned, and I think the widowmaker trade, which is everybody's been betting for 5 years the dollar will go down, could be exactly the opposite of that once again. If the Fed doesn't comply, and we saw it with the Bank of Japan, we'll probably see it with the ECB, we're probably going to see it with the Bank of Canada given their better inflation numbers this morning. The last bank that will probably cut will be the Fed, and that speaks to a potentially higher dollar as well.
Vince, you mentioned the Bank of Japan, and again, the big news this morning on the Bloomberg terminals, the Bank of Japan ending its era of negative interest rates. We got a little bit of positive rates there. What'd you make of that? How important is that?
I think it's kind of a one and done story for the Bank of Japan. I think they just wanted to get on the same page as everybody else. But they're still in a situation where the problem with the economy in Japan is their immigration policy. It's not their interest rate policy. Having a very difficult time growing inflation. So for the Bank of Japan to turn around and start worrying about inflation right now, I think is very, very premature. And that's why you're seeing dollar yen at a 150 handle. I've seen some people talk about if the Fed cuts, dollar yen is going to go to 144. I would so take the other side of that trade. If I were playing this, I don't see that happening at all. I think the Bank of Japan is going to be last once again, and they need to be. They're not in the same position as the other central banks are.
And Vince, I'm going to Europe in a few months. There's a lot going on with central banks' decisions and inflation data and everything else. Am I going to be in a better or worse position in June?
I think you're going to be in a better position. I think, if anything, there's a great debate on the ECB right now. They're all over the place. I mean, you listen to an ECB speaker on a day-to-day basis. One is saying no hikes, no cuts. Another is saying we need to cut right away. This morning there were comments from Guindos about saying that we need to wait till the summertime to see whether or not we're going to cut rates. I think for the ECB, and you look at their economy and their economic growth cycle, far more likely to cut rates sooner than the Fed, and I think that'll speak to a weaker euro and a little more inflation money in your pocket there, or vacation money in your pocket there, Valley.
Is there any bear case for the U.S. dollar, Vince?
Yeah, absolutely. One of the things that a story I read on the terminal this morning is about the pressure we're seeing in CRE. I think the commercial real estate market and the problems in that space are very, very, very underrated. Powell made the comments, and others have made the comments that they think the banks are okay and they're not worried about it. Bernanke made the same comments about housing in 2008 and wasn't quite right about that one. So I think the real estate market could be the black swan event in the U.S. And in that then changes the entire landscape for central banks. and even the governments. But we're in a very different position now in terms of how we would rescue or how we would rescue an economy at that point.
Yep.
We've got $33 trillion on the books of debt in this country right now. That's not what we had in 2008. So where the money is going to come from to save the day is going to be interesting because it's just not really there.
Yep. Vince, thanks so much for joining us. Always appreciate getting your thoughts there. Vince Cignarella, one of the smarter voices we talk to about how markets are moving and reacting to data. Vince Cignarella, macro strategist for Bloomberg News. Your daily look around the front pages. Lisa, Mateo, you got some newspaper stories that we need to chat about, don't we?
We do. Okay, so you know the Stanley water bottles, right? The ones that women love them, the tweens love them.
Yep.
They're like $45. It has a straw, everything.
And they carry them everywhere.
Everywhere.
Okay.
Everywhere you go. It has to. I personally don't have Stanleys, but my team does.
Yep.
And you know who else does? My husband. And
Really?
that's what they're trying to do.
He's not
they're
the demo.
trying to get, he's
Okay.
not the demo. They're trying to flip-flop it.
Okay.
Stanley wants to get more men to start to buy these. And not the guy, the outdoorsy
happen.
guys, you know, who they originally wanted. They want, you know, the new guy, the one who cares about how he looks, his grooming.
Bob Bragg. Like,
So,
exactly. That's what we're talking
there
about.
you go, exactly. The cool guy.
Yep.
They want the sleek water bottle. So they're going to have some new products out, like that sleek one, maybe for you, Bailey, too. See?
I'm more of a Yeti guy, though.
Oh, you are a
admittedly.
Yeti
Maybe
guy.
the outdoorsiness to a degree.
What's
but
better,
okay.
Yeti or Stanley in terms of keeping it cold? Because a Yeti is unbelievable.
I think
those are
Bloomberg should buy me both, and I'll do a side-by-side
Okay,
comparison
all right.
of Stanley and Yeti.
right,
But
I'll
I
put-
do love a Yeti Yet.
I don't
I'll put
know.
a ticket
This
in
is
for
not.
that.
No, this is not a Yeti one. This is the Bloomberg one.
That's the Bloomberg brand one, which I didn't get. I don't know how you get all those. I got nothing. I've been here for
It's special
15 years. I got
people.
nothing. What else you got?
Since we're talking drinking, we're talking about dry January.
Never heard of
okay? Yeah, you've never done it.
No, please.
Never done it. But apparently, a lot of people at Soho House did. They got record sales for non-alcoholic drinks in January. The CEO is saying it's something crazy. They have, you know, virgin versions of old fashions, Moscow mules, alcohol-free draft beer, non-alcoholic wine. But this is all happening even as people spent less last year on food and beverages in the 3 months before January. So they're still into this whole dry January trend, but now it's starting to move on. More people are just go non-alcoholic.
See, I want to know if the margins are higher on non-alcoholic cocktails. Like if you go to New York City, a mocktail, as they call it, are $14 still, and there's no spirit, there's
really?
no liquor. So they're only a few dollars cheaper. I can't imagine that they're not making more money off that. I haven't.
That's a
have
good
to.
point.
done
So it is.
channel
It does come in a little bit cheaper.
a little bit cheaper, a couple bucks, but you're still. My dad, who doesn't drink, is like, why would I spend $14 for something that kind of almost a little bit
juice.
tastes like an old fashioned and is juice to an extent?
Just get the old man a seltzer, right?
Exactly.
All right, what's happening
All
in
right.
Texas?
So the eclipse is coming, right? April 8th. So small budget hotels in Texas, this is from Bloomberg, they are charging more than $1,000 a night for a room because people are flocking to these small Texas towns. And that is 8 to 10 times more than what they normally charge for it. So they're sparking up these prices. Texas, which I didn't know this, why are they going to Texas? It's because it has a lower chance of cloud cover. So that's why people go to Texas to see this.
Are there's certain parts of the country that are going to do better with the viewing of this
Yes,
thing, right?
exactly. And that's why they're saying Texas is better. But you have other hotels, Oklahoma, Arkansas, they're charging like these exorbitant prices for people to stay to watch
So it's
the
April
eclipse.
8th. So the Wine Country Inn in Fredericksburg, a hill country town in the zone of totality.
Okay.
Where eclipse viewing will be at its best April 8th, once $1,288 with taxes for a king.
Crazy.
So I don't know. What are we seeing here? I'm seeing like an eclipse or something?
An eclipse, yes. But if you miss it, here's the thing. There won't be another one covering like such a large part of the country until 2045.
45.
So
Where were
that's
we?
why
Where am I
this
gonna
is
be?
like a big
I
deal.
could still be here for that
You
one.
can still.
All right, rental cars sold out at Austin's airport.
Yes!
RV parks
RV
are filling up.
parks. I'm telling you. And they're charging more too for the
Maybe
RV
that's where
parks.
Tom Keene is. Maybe Tom Keene's in an RV park in
Can
Texas.
you imagine that?
Doing research, channel checking.
I would not bet
Popping
on that
open,
one.
a country, on a tall boy somewhere. Okay, I'll see it. But what do we? I mean, in New Jersey, what am I going to see in New Jersey? I'm looking at the map here. I don't think I'm getting much, but I'll be on the
too much, but
I'll
it
be on the
depends
beach
on
in
the
New
cloud
Jersey.
cover.
We'll see.
That's the thing.
All right, very good. It looks like it's kind of the mid part of the country. Texas
Yes.
through,
Like
I don't know,
right to
Western
the
New
mid.
York up there, up in that whole path there. That's kind of the
But it's
best.
a big thing.
Okay, very good. What else?
All right. The New York Post, they are reporting, because you know how at the Sphere, U2, they just closed their last 40 shows earlier this month. You missed it, see?
I missed it.
Okay, but they're reporting that someone else could be taking the place here. The Eagles. That's what they're saying. Reportedly agreed to residency at the Sphere after they finish up what was actually their final tour this spring, but I guess it's not their final tour. It was a long goodbye tour. It ends June 15th in the Netherlands. So apparently they might be coming back 10 weekends, September through December. No word on, how many shows they're going to have, but it should be a pretty, I don't know.
I mean, I've heard this. I mean, the Sphere just looks phenomenal from every. I mean, I've seen all the YouTube videos. Yeah. It just looks extraordinary, and even from the outside during the Super Bowl. I mean, Jimmy Dolan and the folks at MSG. Man, they really created something amazing.
And I think they paid like $10 million to U2 for doing that.
Just bringing in cash, though.
I mean, it's total Vegas. It's total Vegas.
Yeah. I will say, I was at a charity event a couple weeks ago, and Don Felder, one of the guitarists for the Eagles, performed, and he absolutely shreds. You would not guess he is as old as he is. I don't actually know how old he is.
I'm guessing 70s.
Somewhere older than.
There's an 80s generation, which is the Stones and the Beatles. Yeah. There's a 70s generation, which is now Bruce, Eagles. I guess, those kinds of people. But they're getting up there.
Fun fact, first concert I ever saw was Aerosmith.
Really? That's a good one.
Yeah.
Nice.
That is
fun.
Them and Cheap Trick. I've seen Cheap Trick like 6 times. They open for everyone. If you're ever going to see a 70s band or 80s band, Cheap Trick probably is on the
76 for the some of the Eagles folks.
What was your first concert?
Beach Boys.
Beach Boys.
Yeah.
Nice.
Yeah. Well, I saw. I take that back. Yeah, it was Beach Boys, but then I saw Bruce back, late 70s in Philadelphia. Some club down in Philadelphia. So those were the days. So anyway, the Sphere's a big thing. MSG, Jimmy Dolan making. I wonder how much money that thing makes. I'll take a look at the financials.
Publicly traded.
I know.
SPHR, man.
Yep. SPHR. All right, look at that. So all right, we got the Eagles. Or who's left to tour here. Back. All right, that was Lisa Mateo giving us the latest from the newspapers. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.